Hello, this is Brian Rezny, President of Rezny Wealth Management, bringing you an important update about the economy and the investment markets. We've had quite a bit of volatility the last 3 weeks, of course, all around the coronavirus, which I'm sure everybody has heard about. You've heard all the stories. There's a lot of people out there nervous, of course, about catching it. And our government, in my opinion, is doing a great job to contain the overall virus. Ultimately, though, if you look at statistical numbers on the virus, I mean, nobody ever wants to see anybody pass away, of course, but the death rate is fairly substantially low compared to other viruses from the data we're currently seeing, just to kind of put that at ease. But of course, follow direction, keep apart if you can for a while, and make sure that you keep those hands washed and do all the stuff that the government and of course, our great doctors are discussing that you should be doing. But let's talk a little bit about the economy, what we're seeing with this volatility, because we really want to put you at ease with what we currently see today. You know, we've had about close to a 30% pullback in the equity markets in the U.S. year to date. A lot of volatility that all occurred in about 3 weeks. Some of that really occurred just in the last couple days. And the reason for that is over the weekend, a number of cities said, hey, we're going to limit how many restaurants can be open at a certain time, or shut down bars and restaurants altogether, or maybe other types of events. This is definitely going to slow the U.S. economy for the first quarter and more so in the second quarter. This looks to be a fairly short-term scenario from what we're seeing and what the government is telling us. So what that means is this: while we saw no recession for this year, after the weekend and looking at our research and what has gone on and transpired, we firmly believe we're going to have a mild recession the first half of this year. We feel that's already built into the numbers at this point where the equity markets have come down. In a typical recession, just to give you some numbers, we have about a 32% pullback in the equity markets since 1929 to the last past recession we saw in 2008. That's about the average pullback. We're about there right now, just so you have a good understanding. Typically, once you have that magnitude pullback, usually within the next 12 months following, the equity markets are positive in that time frame. So again, you don't want to do anything drastic. This has been pretty quick and severe. Remember, I've been managing money for over 33 years. I've been around a long time. In fact, I was in the investment business in 1987 when the equity markets in one day dropped 30%, only to see that recoup in the next couple months and go to new high ground and start a new bull market. I remember that day, even today, extremely well. I remember the news. Oh my gosh, the market dropped 30% in a day. Wall Street was going to be gone. There wasn't going to be people ever invested in the stock market again. People thought all their jobs were going to be gone, that the economy was going to tank and go into a deep, dark recession. That did not happen. Things recouped, as I stated, went to new high ground, and people were wealthier down the road. I feel this is going to be no different. I feel this is going to be short-lived. But I think this first quarter, we're going to be down either flat to a little bit negative on the GDP growth because of some of these closures. And certainly the second quarter is going to be down probably between 2 to 4% on GDP. But ultimately what's going to happen the second half of this year, and you have to look forward when you're looking at earnings and how the economy is expected to grow. This is supposed to be short term. A lot of these closures over the next 2 to 4 weeks, let's say, maybe 6 weeks. What's going to happen in the second half of the year is we are going to see pent-up demand. Money that you are going to spend in the first half that you really can't spend because things maybe are shut down or you're a little bit more quarantined at home, kind of keeping away from everybody based upon direction, you're still going to have that money. You're going to go out to dinner a few more times than you normally would in the second quarter. You're going to do more events. You probably will travel. So ultimately, that pent-up demand, which we've seen every time when we have these kind of short-term pullbacks in the economy and or recession, the money then is pent up and spent in future quarters to bring the GDP actually up quicker and make up for lost GDP from the past. This historically has happened quite a number of times, and I don't think this time is any different. So expect this volatility probably to continue for the next, I would say, 2 weeks to 2 months. I don't see a lot of downside, an additional downside, but we could get some. But remember, you're well positioned. Our clients have some money, depending on the risk profile, that's in safer investments on the bond side. You can weather these storms. Most of our clients have 3 to 5 years minimum in their portfolio of safer assets that we can draw upon without selling assets that are down temporarily, in our opinion. But of course, if you're a little bit more concerned, we can always raise a little bit extra cash just to make you more comfortable. But again, these storms will pass. I've been doing this over 33 years. Statistically, these storms last anywhere from 6, 12 months, maybe a little bit longer. We're going to get through this together, but I know it's nerve-wracking for a lot of people. One of my big suggestions to every client, turn off the media. Turn off that ticker on the bottom of your screen. If you're sitting home all day and just watching that, it's going to drive you crazy. Let us do our job. We're going to watch the ticker, but we're really doing research on a daily basis. We're getting positioned to make some changes to our portfolios, what we feel will help recoup the portfolio faster as the economy regains its steam and it going in the right direction. Let us do our job. Do something different than watching the TV and the ticker. It'll make you feel a whole lot better. But let's talk about this virus. This virus, while it's bad, is ultimately going to change the global landscape. And what it's going to do for the U.S. economy, in our opinion, it's going to help the U.S. economy and the consumer on a long-term basis. Let me explain why. A lot of people would travel overseas for years and years. I think ultimately, when travel kind of restarts again in the next couple months, a lot of people that were going to go overseas travel are going to be reluctant to do so, but they're still going to travel. It's just going to be more inside the U.S. So that means your dollars will be spent more in the U.S. Those supply chains, especially in the Asian countries, China would be a great example. They produce 80% of a lot of our generic drugs and or the ingredients to make those drugs. I see more and more supply chains because of this virus coming back to the U.S. Our government and businesses are starting to realize being dependent too much on these other countries puts us at some degree of risk. So ultimately, while this virus is bad, what we do see though is as we go back on track in business, I see more and more businesses and our government bringing the supply chains back to the U.S. and ultimately strengthening our economy, strengthening our recovery long term, creating more jobs and better paying jobs. So this will help the U.S. economy. While it looks bad today, I'm looking towards the next 12, 24 months, and ultimately the next decade on where we want to be positioned as we see these supply chains coming back to the U.S. This will pass. We're all in this together. Again, I've seen many volatile markets in my 33-year investing money. Our clients that were with me then, a lot of those are still clients today. They survived and many became wealthier. You, in my opinion, would also become wealthier over the longer term. Regardless of age, the key is keep on track with your strategy. Just because we've had some short-term volatility doesn't change the direction ultimately of your strategy and or your goals and objectives. Don't make short-term decisions or knee-jerk reactions and upset your long-term financial plan. But of course, if you've got concerns, please call the office. Let's discuss. We'll make sure you're aligned properly so you're happy and it kind of curbs maybe a little bit of that volatility that you are feeling. But we will get through this. The economy is going to be stronger in our opinion. Supply chains will come back. You, the consumer, will go back. History has shown that you, the consumer, are strong. It might take you a couple months, but ultimately you're going to go back to spending and living the life you have. But you're going to spend more in the U.S., which is going to, again, strengthen our economy and our financial security. Call our office if you have any questions or concerns, and make sure you have yourself a safe and healthy day, and stop watching that news, turn off that ticker, spend more time with your loved ones, and do things instead of creating emotional stress on yourself, which is ultimately a lot of media that doesn't really tell you much other than maybe things you don't really want to hear about, they're going to be gone in the next couple months anyway. Have a safe and profitable day.